Today, ladies and gentlemen, the stock market crash is officially over. And I can say that with some pretty good confidence as I break down the data in this video that supports those statements, as my accounts have been rallying so damn aggressively, and out of my own fear that the market was going to rally long before the interest rate cut cycle. As many of you are aware, I was just throwing tens of thousands in the market over the last couple months to my benefit. Is I'm going to show you the ETFs and where they currently sit after this crazy rally this week at the end of this video, because I hit records that I didn't think I'd be hitting this early. I mean, it's only been a damn week here, folks, but a lot of people think that this market recovery that we're currently seeing is fake. They're saying that the valuations are too nutty. This is like the dot-com bubble where we're seeing the relief rally, and because inflation, the core inflation, is too sticky, because obviously PEs are too high, that this is going to come crashing back down to new lows. And you need to be fearful. You need to hoard cash, and it's turned all of you into a bunch of little biatches because you just missed one of the greatest rallies you could have experienced, and you can't miss these rallies. These days you're out of the market kind of eat through your entirety of your best returns through your lifetime. This is why you got to be buying. This is why you got to remain strong, and that's why I beat this like a broken record on this damn channel, and I just put my money where my mouth is to help keep you guys on track. This is not financial advice. I'm a damn clown, but this clown does better than all the damn YouTube clowns out there. Just hit that like button if you believe that, baby. So let's get into it by first and foremost talking about inflation. So core inflation has been sticky, but it's been sticky for the reasons that I've been saying, which is primarily that interest rates are causing inflation now. You raise interest rates, mortgage prices go up, the landlord's got to raise the price on the tenant, that keeps rental prices up, and sure enough, the headline of inflation this November for this data was shelter. Shelter is one of the leading causes. It's up 4 percentage points, but we're starting to see a lot of deflationary pressures on a lot of other aspects of the economy, and that has been primarily driven by oil. Oil is completely fallen off a cliff, and that brings down the prices of everything: food, travel, housing materials, because you got to transport all this stuff everywhere. So this is going to take some of the edge off the end consumer, and this is what led the Fed to saying, hey guys, I think we need to stop raising interest rates. I think we're coming to the end of that cycle, which leads into the next conversation of when are we going to start getting interest rate cuts. But I want to explain to you why the market has been exploding so aggressively on the interest rate pause, why we're not going to hike anymore, and what it means for the broader economy, because that's going to take some of the pressure off the real estate market as well. But let's first and foremost look at the broader indices, and then I'm going to focus in on tech companies and the stocks and why I've been buying dividend stocks specifically so aggressively. But firstly, the S&P 500 is basically at an all-time high. You've been collecting over 1.5% dividend from the peak of 2022, and we're only down 0.7%. So we are basically at an all-time high, taking into consideration the dividend. The Dow Jones Industrial is up 2.5%. Forget the dividend. Just from a capital standpoint, the capital gains, you're there. I mean, the NASDAQ is trailing behind it, about 7.8% down. The Russell here, small caps in the US, devastated, still down 17%, but rallying the most from the October low, up 22 damn percent. And then on the Canadian side of the border, we are down about 5 percentage points. But again, take into consideration the higher yield you get in Canada, and we are at an all-time high. Now, let's take a look at the indices themselves to show you why dividend stocks are the ones bringing the market back to life. They were the most oversold. They had absolutely no recovery in them up till basically the last couple weeks, and tech stocks have already been overbought. We've seen tech stocks have a full recovery because they weren't as inflicted on their balance sheet by the interest rate cycle because they have little debt. And we can see that a lot of these are only moving in the single digits, whereas like you look at the oil companies, even though oil is trading down, a lot of oil stocks got hit so hard over the last couple months that we're starting to see a bit of a recovery. I mean, you look at the bank stocks, they're up double digits. Wells Fargo, Bank of America almost hitting 11 percentage points here. Are you effing kidding me? I mean, this is nuts. On the TSX, the Canadian side of the border, similar deal. The bank stocks are all up over 5%. Oil stocks have been rallying this week nicely. And what this leads into is the ETFs that I've been buying. Now, we'll take a look at just a wide variety of them. Now, XEI in Canada here has been an equal weighted dividend ETF, so it hasn't had the same recovery because of that equal weighting. It's still down about 13 percentage points, whereas VDY here, one that I've been recently buying off the lows, is only down 11.3% from those highs. But let's do a quick comparison, because I mean, VDY from the October low is up 11.24%. XCI here is up about 11.15%. So they're both fairly in line from the October low. SCHD has been a wonderful one for me here because I'm finally back into the green on this one. It's only down 7 percentage points. Again, dividend probably take it to an all-time high. You got VYM, also a wonderful U.S. dividend ETF here, and this one's basically at an all-time high at this point. This one's at a full recovery. It's only down 2 percentage points, but the yield is definitely taking you well beyond that. And I want to focus in here, and we'll talk about the dividend stocks and why they still have a lot of room to recover. And I'm really anticipating this is where there's going to be some good gains leading into the first interest rate cuts, but let's start by talking about tech first and foremost. Now, when it comes to tech, because of the lack of debt a lot of these companies had on their balance sheet, they were able to refine and dine the interest rate raising cycle because they basically did a bunch of layoffs. They made their balance sheets a lot better so they could retain earnings because these were the stocks that crashed really heavy. Now, Apple hasn't seen a return in its revenue, and it's the only stock that is the exception out of the Magnificent Seven, because if you take a look at something like Microsoft, their revenues are back into the 12% growth rates, right? They're returning to where they were basically post the interest raising cycle. So they're doing great. You look at something like Google here. Google's back into the 11% growth rate cycle. They're basically into full recovery mode. You look at something again here like Amazon. Amazon's similar deal. It's growing at a 12% clip, and Meta being a huge exception here, back into the 23 percentile of growth in their revenue. So long as this continues, tech stocks can't really be called overvalued. Trading at a 20 to 30 times multiple makes sense when your revenue is growing at that pace. And because, as mentioned, they refined and dined their businesses after, everyone paused on ad spending and all this stuff, and we saw revenue drop, they really made it so they were able to bring in a huge amount of net income. I mean, Meta saw a 164% increase on net income. So tech stocks, they're going to remain expensive. They've had the recovery and they're back to a place of normality. It's nominalized a lot, in my opinion. Now, you could say they're a bit over expensive here, but presuming the revenue continues to go up from here, I mean, there's no reason that you're not going to be paying a higher multiple for that. But the stocks that I've been interested in are your telecom giants, your infrastructure companies, and primarily just your dividend stocks, because these ones have come nowhere near close to a full recovery. I mean, you take a look at TELUS, for example. This is a big telecom giant here in Canada. It is down 28%, and it has had a nice little bump up here. We've seen about a 12% gain, and I want to explain to you what caused this big bump up here and why these stocks still have a lot of room to go. Because first and foremost, when it comes to companies that are heavily debted, that are relying on debt to run their businesses, that are primarily infrastructure companies that can't really go anywhere, we can't let them go bankrupt, they're too integral to the entire economy. I mean, these things have been putting so much money to interest, growth, they've been losing on earnings. Like, their earnings fell off a friggin' cliff, and the reason they were able to rally here on the recent Fed news is because that means we're going to start seeing a pause in interest rates. That means we're not going to be making any more higher debt payments on, or higher, interest payments on our debt. And that means the EPS is going to level off. So we're not going down anymore. So if we're not going down, there's no reason to project that into the future, and we can start to flatline. And that means we're going to see a bit of a bump in the stock to make up for that future projection, right? But TELUS is a company that's making record revenues. It just hasn't been able to actualize these revenues. So as we head into the first interest rate cut, all of a sudden they're going to be pulling that interest payment on their debt back into the bottom line to benefit us shareholders. That's why I think owning dividend stocks is still very advantageous right now. Now, in my opinion, you should own everything. Like, I own the broader indices, I own the dividend stocks. Let's just take a look at these ETFs and where they're performing for me, because first and foremost, SCHD, literally, you go back not even a week and I was negative on this position. I've been holding this for the last 2 years and I haven't seen a positive gain in quite some time. And now we're up 3.5%, literally overnight. So we made a $1,700 gain on the Canadian side of the border. That's $67,560 total invested, and we've been collecting dividends and reinvesting them over the last 2 years, this whole down cycle. So we're seeing a wicked, awesome gain from that. Now let's take a look on the VDY side of it. I should have just been buying some of the individual stocks, but as mentioned, because at the end of this year, I'm selling all of this and putting it in my tax-free savings account. I don't want to keep paying fees, because here in Canada, I got to pay a $10 commission on every buy and sell. It just got too expensive. It was too messy, and VDY holds my favorite dividend stock, so I figured I'd just concentrate into this so I can easily sell it and move it at the end of the year. And hey, from buying it just at the October lows there, I mean, in cost averaging, we're up 5.7% here, $695 gain plus the last dividend that we just collected. We're sitting in a pretty good spot considering for where we started buying it. You take a look at VOO, my next third largest position here, and I threw a lot of money in this over the last couple of weeks. I mean, I think I ended up dumping like several $1,000s into it, 6 or 7 grand. I mean, we're up now 13.7%, over 9,000 US, which is just wonderful across the board. What does this look like? First, encompassing where we sit right now, considering the gains that I've experienced over the last day or two that have not been calculated into my iCloud number sheet. This only updates like once every 24 hours or something, but I'm sitting on about $16,000 in capital gains. We've received about $7,823 in dividends so far this year. That brings us to $24,000 in total return, and most of the cap gains didn't really get experienced and actualized until this year, considering in 2022 when the market was primarily down, we were still received about almost $12,000 in dividends. But keep in mind, not only did we purchase a piece of real estate this year, but everything in combination, my accounts are back up over $200,000, something I didn't think was going to materialize at least until Q1. But this primarily has to do with me not taking into consideration the precious metal investments I have, these small caps and venture capital investments I have, but with cash, cash equivalents, and just what I have invested sitting at well over 182,000 now, because it hasn't taken into consideration the recent gains. We are in a very, very great position. And I'm very grateful to have just stuck to my guns and just kept investing as aggressively as I have. And the goal for next year is I am not done buying here, folks. I still think there's an incredible amount of opportunity out there. We got a lot of growth ahead of us. We haven't even got into an interest rate cut cycle yet. And unless a black swan event happens, yeah, there's parts of the market that are being exposed like a megaphone, because that's what the media wants to discuss. That's what gets clicked, is the struggles of these people. And there are people struggling, don't get me wrong, but the jobs market is so damn strong, and I just can't imagine that the vast majority of people are struggling that bad. And especially now in a market recovery where people think, hey, now that we're experiencing all these gains, that's going to lead to people spending a lot more money, and that's going to lead inflation back up. And that's not true either. I mean, we just came out of a decade of one of the best rallies in the market ever, and inflation was in check the whole time during record low interest rates. This entire inflationary cycle has been purely caused by the Fed printing an ungodly amount of money. And even during this ungodly amount of printing, the US dollar has been stronger than it ever has been in the past. This is truly the first soft landing ever in an interest rate hike cycle, and it is probably one of the most mild recessions we've ever experienced, showing you damn well how strong the Western economy truly is and why you need to be invested in it. But I'll pass that question off to you. I'd love to know what you think in that comment section below.